Well, good afternoon, everyone. Well, I guess I thought this was a live event. Is this on Zoom? Oh, I'm very sorry. Welcome today. As you can see on the screen that I'm sharing, we have a very 2020, a year full of surprises. One of the surprises is that I never would have expected to be wearing a mask and/or doing Zoom meetings for this kind of presentation. So obviously we've adjusted, we've adapted, we've done many things over the last 6 months and changed a lot of lives and as a result. Some of the surprises that we didn't expect, and most of these I'm going to try to keep oriented toward agriculture, but obviously the pandemic, COVID-19 and all the ramifications from that, totally unexpected by anyone, and we've had to deal with it and make adjustments accordingly. No one predicted in March, April, that we would see crashing prices, whether it's the stock market, whether it's commodities, just a total devastation of many of those markets. In fact, oil going into the negative price territory. No one expected to have a work from home order. Never had that before. First time. Largely didn't impact production agriculture as much as what you might expect, but certainly had an impact globally. Interest rates. Interest rates go to zero effectively and remain extremely low compared to historical numbers. Chinese trade. We had an on agreement. Then that agreement kind of got delayed because of COVID-19. And then over the last couple of months, clearly Chinese purchases have really ramped up. So a little bit of on again, off again impact from Chinese trade. Then last month, we had the derecho event, followed by drought in many areas across the Corn Belt throughout August and September. We got this election thing coming up in 5-6 weeks. And then we've seen commodities rise over the last couple of months to the point where prices today, arguably, if you use average yields, are entering profit territory, certainly for soybeans, and getting close for corn. And if you factor in the government support program payments through the CFAP programs 1 and 2, you certainly could be looking at some profitable opportunities for growers this year. So a lot of surprises. No one predicted any of those events except for the election thing prior to this year. So I'm Howard Holderman. I would like to welcome everyone in today on behalf of the Holderman companies. We had our corporate staff meetings. We do them semi-annually. We had those last week, and I asked all of our team of area representatives and real estate associates to offer their opinions on land values and on rents for 2020 and 2021. And so I thought with those survey results and with those opinions, we would share those with you today via this webinar. So thank you for joining us. We are going to keep most people on mute today. Please use the chat feature down at the bottom of your screen here in the Zoom. Use that to send in any questions you might have. Nolan is monitoring those. He'll kind of assimilate similar questions together and then pass them over to me so that I can answer them as we get to that. So with that, I'm going to dive into the presentation today. The screen behind me, or the wall behind me, is filled with many of our area representatives. So I'm going to provide you a general overview and general opinions as we see things here in the Eastern Corn Belt. But certainly, if you have questions about your specific property, any one of these people up behind me are the experts in their regions, and they would be happy to help you navigate those decisions. So we talk about, get my slides to move. So many of you know who the Holderman companies are. We're in our 90th year this year. And my grandfather there in the middle started our business in 1930. And since that time, we've been providing services to landowners. And many of you are landowners. So variety of kinds, individuals, trust officers, wealth advisors, accountants, attorneys, somebody representing somebody who owns land, and industries as well. So we've provided these services, farm management and real estate brokerage and appraisal, to thousands of clients for many, many years. And you can see here our farm management size of our business, the real estate sales that we're doing, and then also the farm appraisals. So it's kind of a three-legged stool for us, but it allows us to be very familiar with land rents and very familiar with farm real estate values in the region that we're located. We are a third generation ownership company. We've got 22 area representatives and 11 real estate associates throughout the Eastern Corn Belt. Average tenure of our staff is greater than 20 years. So when you call one of those people on the wall behind me, you're getting somebody who has been in that area for a long period of time, and they are certainly experts in that territory and region. And then you can see other locations across the country where we manage properties today. So let's talk about farmland. And I would like to tell you, I think Debbie reserved this for a 2-hour time slot. We're not going to be that long. I would imagine we'll be somewhere 45 to 50 minutes today. And again, we just appreciate your interest in farmland as a subject. So we have been in a very stable farmland value time period. And the question is, for how long will that remain? It's been 5 years. We've been in this sideways channel for 5 years. So let's talk a little bit more specifically about some of the reasons why. First, there are have been very few outside drivers of farmland sales from 2013 to 2020 until, and you can see question mark, we are now arriving at a contested election, heavily contested election, differing opinions on each side of the aisle on how taxes will be going forward. And we have had some landowners call us and say, we want to sell our farm and close before the end of the year because we know what capital gains taxes are today. We don't know what they might be in 2021. So that's kind of an outside driver of farmland sales, when somebody's making a decision to sell and close before the end of the year due to capital gains taxes. We've had very few of those kind of drivers over the last 7 years. Second point, number of sales, farm sales remains below normal. In fact, when COVID erupted, we had 10 auctions scheduled in April. We talked about those at our webinar back in May. And while they were mostly successful, the market then just shut down. And we had very few sales in May and June and early July as everyone tried to figure out how we were going to navigate work from home and the COVID restrictions and getting back to normal and all those sorts of things. So really the number of farmland sales remains well below normal, especially for larger tracts. As I said earlier, cropland values remain stable and have been in this stable zone for the last 5 years. Now what's been interesting, when COVID initially broke, we suspicioned that recreational land, timberland, and rural residential values would be hurt by that. In fact, as we've seen with residential values across the country, COVID actually had a positive impact on residential values as well as recreational land and timberland. So it appears that while COVID was negative to many markets, it has not been negative to that segment of our rural countryside as we look out across the farmland today. The 7th District Federal Reserve Bank of Chicago, they do a survey of their ag bankers on a quarterly basis. This is the most recent quarter. I talked about a very flat marketplace, and you can see the 7th District as a whole, July to July, July 19 to July of 20, up 1%. You can see Indiana was up as much as 4%. Most of that occurred in the second half of 19, not so much in the first half of 20. But Iowa, Illinois, basically flat year over year. So as I said, land values have not changed much. And again, this is a July report, so the impact of COVID, negligible. Here's the Purdue survey. So Purdue does their survey in June every year. It publishes in August. So as of June, you can see the opinions for 3 different land qualities here in the state of Indiana. The blue line being the top, and then the red being the more average quality land. And you can see how over the last 5 years, in fact, there's a general upswing in land values. Now, I would argue that that bottom category, the red line, might be overstated in terms of the uptick this past year. In our experience with farms that we're selling, average to below average land is the component that's struggling to get bids at auctions. Maybe the bidding's a little slower. So the best quality land is certainly stronger this year, but the average, below average quality land is the one that's finding fewer bids and less interest today. One of the ways we measure our sales is a productivity index, and we basically take the sales price per acre of an acre of farmland, so $8,000 an acre, and we divide it by the productivity index for corn, bushels per acre, and that is done by looking at the soil types that exist on that property. And so it's not uncommon in Indiana to have a WAPI score of anywhere from 100 bushels per acre up to about 180 bushels per acre on the high side. That really doesn't indicate what the farm will actually produce. Those with WAPIs of 170 to 180 bushels probably produce well over 200 bushels in reality. But it is a way for us to compare farm to farm, because we can look at the WAPI of one farm and compare it to a second farm, and you will know quality differences based on soil types. But it also allows us then to divide that sale price by the WAPI and come up with so many dollars per corn bushel of value. And this is 2019's graph. You can see we began the year at about $46 per corn bushel of productivity index. And we ended the year almost up to $55 per bushel. Again, I talked about in the Federal Reserve Bank that big 4% increase in Indiana probably occurred in late 19, and this is evidence of that. And these are our actual sales. So this really confirms what I believe to be the trend in late 19. Then we turned the calendar into 2021, and we began the year where we ended 2019. Above $50 per corn bushel of productivity index. But you can see that we've had a slight decline. Now, depends on the quality of farms you're selling to some degree, but the trend line, that red line, would indicate that we're somewhere in the mid $40 per corn bushel of productivity index. I would never use that number as a rule of thumb as to how you would sell your farm, but it does give you an indication of potential value, and you would want to really have one of our area representatives look at your property and offer their opinion of value before you would use this as your number that you would want to use for making a sale. But it does give you kind of the trend in 2020, which would be indicative of a little lower pricing. But I said earlier, we've been in a 5-year sideways land value channel. And this is documentation of that. You can see the linear trend line there, the red line, and it does not move for the last 5 years. So basically, based upon our auction sales and private sales that we have factored into this, it is a very flat marketplace since the beginning of 2016. Here's another way to look at it, is more of a bar chart. And you can see that while that line is flat, it truly is, because we're somewhere around 49 and a few cents per corn bushel, maybe a little bit over 50 in 2017, but the other 4 years of the last 5 have been in that 49 range all along. And you can see the decline from the all-time high where we were above $60 back in 2012 and 2013. One thing I want to point out, those of you on this webinar today will have the opportunity to, you'll get an email basically announcing our new app that'll be coming out. We've had an app in the past, we've had it updated, it'll be much more user-friendly. And this app will give you the opportunity to know any new listings, you're going to get a notification if you ask for it. Sales results, auction last night, you want to know how it sold, you're going to get those sales results on that app. You'll be able to look, if you're driving through West Central Ohio, for example, does Halderman have anything for sale in this area? And you're going to be able to look at a map and see what listings we have in that vicinity. So it'll be much more user-friendly, offer a lot more power than what our old one did. And it is in the final, basically, development stage right now. Then we've got to send it to Google and Apple for approval. Once we have that done, you'll get an email notification on that and have the opportunity to sign up for it. It's a free app, obviously. So I mentioned the survey earlier. This is a survey of our staff, and I asked them, as of September 1st, 2020, what was your opinion on the percent change in land values from the previous September? And you can see that I have a range for all categories, but generally speaking, they felt like in their area, the best cropland was either maybe up as much as 7% or down as much as 10%. Again, pretty much an average of no change. The same now, average cropland, I said earlier, average to below average is a little more of a struggle to sell today. And you can see that evidenced in this part of the graph, where maybe down 15% in some locations. Timberland, a little stronger on the upside and a little less negative. And then you see rural building sites and rural residences, both the high and low end of that range are positive. And again, somewhat of a surprise, I think, with COVID, but there is demand from people. Maybe they want to exit those larger metropolitan areas and move to the countryside. And I think that's indicative here in the value change that you see. Livestock facilities, dairy, pig prices have not been the greatest this past year, and that's indicated in the lower values there. Who are the dominant purchasers in the marketplace? And this is always an interesting chart to look at. And you can see for 2020, it's a 60-40 split, farmer to farmland investor. Last year, it was about 66% or 2/3 for farmers. These are our sales. So these are transactions that we did, and we document, was that buyer a farmer or were they a farmland investor? And you can kind of see how it ebbs and flows over the years. But with the lower commodity prices, those who actually are on the farm and doing the production tend to be a little stronger buyer. I asked our group, when you look across your marketplace, are there more sales, less sales, or the same? And clearly 75% of our group felt like there were fewer sales this year than a year ago. I also asked them on the whole marketplace, not just our sales, but all of the marketplace, who is the predominant buyer? And you can see that 70% of the marketplace for them are farmer buyers. We're at 60% on our sales. We might drag in a few more farmland investors to our auctions, but you can get the feel here that farmer buyer is the majority buyer in our land sales and in this land market. Now, one of the things I've talked about over the years, and if you've heard me present, I've mentioned the Purdue Ag Barometer. It's in conjunction with the CME group that Purdue does this, and this really documents what we experienced this year. The roller coaster of COVID. Especially from an ag economy standpoint. We were on cloud 9 back in February at 168 on this value index. The maximum's 200. The minimum is 0. 100 would be I feel average. So they're basically asking 400 producers, how do you feel about the future of agriculture today? And they respond and they accumulate the score. And we were really feeling pretty good back in February. Then obviously COVID outbreak occurs, and by the time we got to May, I think that's May at 96, so below average at that point, and the lowest value we had seen since the barometer started back in 2015 and early 2016. Then you saw the election of Mr. Trump, and you can see that we've been in that 125 plus 130, 150 range ever since until the COVID down cycle. But agriculture had a pretty good planting season, followed by, as we got later in the year, some higher commodity prices and some government support payments. And you can see that as of August, we're up to 144. So as we come into this fall, at least attitudes out in the ag marketplace are pretty positive today. So let's talk about debt first. And I like to make a couple of points as I go through multiple slides here on debt. First of all, on the real estate, and this is inflation adjusted. So if you take inflation out of it, real debt is higher than it was back in the late 70s, early 80s on real estate. But it's not on non-real estate. So when I say non-real estate, think operating lines of credit, think equipment loans, those sorts of things. So overall, total debt is probably pretty equal to where we were back in the early 1980s. So while that's concerning, the next slide shows one of the big mitigating differences. And that's interest expense. And as I said earlier, interest rates remain extremely historically low. And we reached the low again back last spring. Well, if you go back to the early 1980s, look at the interest expenses paid on the farm compared to where they are today. While debt is about equal in total dollars, inflation adjusted, the interest expense is dramatically less. And so we were dealing with interest rates back in the early 1980s in the double digits, maybe some as high as 16, 17%, and we're not anywhere near that today. So that's a big, big factor in terms of the profitability on the farm today, is that lower interest expense. Also a big factor to the federal government and the debt that they hold. Here's the debt to equity ratio. and debt to asset ratio. And you can see when you're in a sideways marketplace for land values and farm incomes aren't changing a whole lot, debt is increasing, you basically see that debt to equity or debt to asset ratio increase a little bit since the 2012 time period. But again, it's just increasing a little bit and nowhere near the concerning levels that we had back in the 1980s. Debt to income is another way to look at debt. And this is your total debt divided by your income on an annual basis. And it becomes concerning when it goes above a 5. And we were there 4 years ago, but now we've dropped back to a 4.5. So nowhere near, again, what we saw back in the late 1970s, early 80s, and trending downward at this point in time. So we'll see how that goes forward. Here are 3 slides, I believe, on delinquencies. So these are non-real estate loans. So think equipment and operating lines. And you can see since 2014, the number of loans delinquent is trending up. But look at the black line, it's 2.2% or something like that of total loans. So it's a pretty small percentage anyway. And you can see we just got back to the long-term trend. Again, nothing like the 1980s. Here's real estate loans. So this is actual mortgages on the farm. And you can see that it hangs somewhere in the 2.3, 2.4 as a long-term average. And we've just also returned to that level. Again, nothing like back in the 1980s. And then the volume of delinquent farm real estate loans, billions of dollars. We hit the low in 2013-14, no surprise, coming out of the golden era of agriculture, and we've trended higher ever since. But again, not exceeding levels previously seen in this decade. Here's the one concern, and that's working capital. We've talked about this before if you've heard our seminars, and this really graphically represents the declining working capital, and that's cash, basically. So what cash do I have on hand to pay bills? And we're getting down to about a 12% number. That's getting down to pretty low levels, and that is concerning for those operations that are really struggling to maintain cash. Now, the CFAP programs help, certainly. Higher prices this fall are helping tremendously. So we hope that those things continue, but that's left to be known, and especially with the election coming up in a month or so, what the new or the current president want to do in terms of government programs and stimulus programs into 2021 will be a big question in agriculture going forward. Here's some things on bankruptcies, 2 slides on this, and I just want to keep these in perspective. I have in there March 19 to March 20, Chapter 12 filings, 627. This is across the entire country. If you go back to 2018, it was 498. That's a 23% increase, and that is significant, no doubt about it. However, if you compare back to 2008, we had 250. So that was a pretty good time economically. It wasn't in the general economy, but in ag it was. Go back to 1987, where we had 5,800 Chapter 12 filings. So while 627 is concerning, and the 23% increase is concerning, we're nowhere near what we were back in the 1980s. And then this just shows where those 627 bankruptcies have been. And you can see that there's a big number up in Wisconsin. That would be your dairy industry, and others around in other states. But here in Indiana, Ohio, Michigan, pretty average numbers, comparatively speaking. So let's talk about farmland values. That's the debt picture. Now we're going to talk more specifically about values. And really, farmland values depend on these 3 things: incomes, interest rates, and supply. I've said this for many years. Now, you had the golden era where a lot of cash was generated on the farm income side. Arguably, the last 6 years, we've seen lower incomes, in fact, much lower in some, this year better than others, and that's been the cash drain, and that working capital number has gone down. Government support has been critical the last 2-3 years. The support offsetting the trade problems with China the previous 2 years in 2018 and 19, followed by the CFAP program payments this year to offset COVID impacts. That's been absolutely critical to producers and keeping them in a cash positive position. And then, as I showed earlier, interest rates still historically low. That's a positive. and farms for sale are about 3/4 the typical 2%. So we've got a low supply of farms for sale, we've got very low interest rates, and we've got farm incomes that are being supported by every year an opportunity to sell your crop at values that are profitable, combined with some critical government support. And when you put all that together, I guess it's not surprising that we are still seeing land values hold pretty steady. Now let's just talk quickly about farm incomes. And I shared this. This is information coming from our 20 area managers, and asked them total production costs for 2021. And you can see, including rent, corn somewhere between $600 and $725 an acre. All right, if I do simple math, because that's what Howard can handle, 200 bushels per acre of corn times $4 a bushel is $800 an acre gross income. If it costs me $700 to produce that, including rent, I'm going to make about $100 an acre in profit. So you can see that if I don't make 200 bushel to the acre, or I sell at $3.60 instead of $4, how profit margins get pretty thin and working capital evaporates. You can use the same kind of math with the bean numbers. Obviously with soybeans, you might be talking about 50 bushels to the acre times $10 a bushel today. That's $500 in gross income. And you can see that's not far above your cost of production. And then you see the numbers without rent included. And obviously rents vary. You know, many of ours are in that 250 range, plus or minus. One of the opinions that our guys shared is that some of those high rents, probably exceeding $300 an acre, are the candidates to come down this year, but not so much the others. Here's the impact of USDA payments, and this is direct farm payments as a share of net farm income. And you can see, no surprise, that during the golden era, we got really down to a pretty low number of 10% was coming from direct farm payments. Of course, that's because most of the income was coming from much higher commodity prices times pretty good yields. Combine that, or you basically shrink your commodity prices and farm incomes drop. From a production standpoint, the share really jumps back up, and we're back up, getting closer to 30% here most recently. So it's a major share of the income on a farm. This is cap rate, so this is income divided by value. And you can see that we've, for the last 5-6 years, been in around 3% cap rate. So your net is somewhere in the 250 to 275 range on the open market. And all land categories really fall into that. So we're going to talk quickly about leasing. I asked our staff, cash rent results. What were the results of any 2020 cash rents? Now, I would tell you September 1st is really early in the year. We haven't negotiated a lot of rents for next year. So I asked them, you know, what did you experience for 2020 cash rents? And you can see most people were steady. Would you lower any cash rents? 4 said they would, 10 said they would not, and 3 were undecided yet. So those 4 that would lower them, they would take them down anywhere from $5 to $20 per acre. And again, this is September 1st. We've seen an increase in commodity prices in the interim. Now, is there more or the same amount of land for rent compared to 2019? And you can see that maybe a little bit more was the trend. Is there more or less of the same demand compared to in 2020? And very similar demand. In fact, one of the guys said still pretty strong. So maybe a little more land for rent as you get some retirements, but similar demand to what we've experienced in past years. Did you have any tenants default on a lease? We had 1. Now we manage 600 plus farms. So to have 1 default on a lease is pretty negligible. And did you have any tenants give up their lease rather than renegotiate? And we had 2. So really not a lot of change due to the current economics on the tenant side. Cash flex leases, I asked about base gross revenue numbers. Now, you have to understand cash flex leases before you might understand some of these terms. But this is the point. The base gross revenue is the number that we would use to basically, the farmer gets this first $675 per acre they get to keep off the farm. And then any dollars above that might be split with the landowner as a profit sharing bonus. That's the way, that's the flex part of this cash flex lease. So you can see the base gross revenue is anywhere from $675 to $750 an acre, or $450 to $650 before rent. So somewhere around $700 an acre is our average base gross revenue. So back to my example, if I made 200 bushel corn times $4, that's $800 an acre. That's $100 an acre of profit that might be split maybe 25% to the landowner and 75% to the tenant. And so that landowner who might have gotten a base rent of $250 an acre, let's say, and you can see down at the bottom of the slide, that range is 180 to 250. Maybe if they got 250, they add another $25 an acre on top of that in a bonus payment, and you get up to 275 rent in total. Purdue survey of land rents, and you can see that this mirrors land values pretty closely. That's how important farm incomes are to land values. And again, maybe a little bit of an uphill trend here on all three land classifications, but certainly not where we were back at the peak, although that average land quality is creeping up close to it. Here are USDA rents. Now this is the entire United States. So cash rents all over the country. That's why it's at a low number like this. But you can see peak in 15, dropping off in 16, and then slowly creeping back up toward $140 an acre. So consistent again with what the Purdue average surveys show. So let's talk about where land values are going this fall. You still have long-term world demand fundamentals are remaining bullish for agriculture. The UN FAO report shows we need 100% more corn or more food by 2050. Interest rates. So you got demand, that translates to higher prices, translates to higher incomes. So incomes is one part of the equation. Interest rates is another part. And right now, 15-year fixed, according to the 7th District of the Chicago Federal Reserve, the average rate on that is 4.4%. That's pretty cheap money, lowest ever in the history of that survey. Supply of farms for sale remains low for now. Now, does that change if we get a few more farms coming on the market due to fears of capital gains tax increases? That could. But as of here, September 23rd, the supply of farms for sale remains fairly low across the Eastern Corn Belt. We have government support, and the question is really, for how long will that stay in place? How long can they afford to keep it in place? And so that's really a big question mark as we look at 2021. Clearly, I think we know where we stand for 2020 with some of the announcements this past week on the CFAP2, but question marks for next year. And then how much cash is in the countryside? How much working capital exists out there? So all-time high values for prime farmland. The peak was in 2013-14. Believe it or not, while we saw that 20% decline, we're still in the 80th percentile of all-time high land values. So let's talk about each little piece of that rural marketplace. Timber. I put question marks there. It's kind of been a mixed report. Timber has certainly been hurt due to less demand from China. And with their COVID problems and their manufacturing industries being shut down for a period of time, that demand for hardwood timber has been down. So timber itself is kind of been steady. You would think it would move higher. And I think in the softwood timbers or the building construction timber areas, that has actually trended higher. But our hardwood timber, maybe not as much as what you might expect. Recreational land, we've seen that remain pretty strong. And actually, we think that's going to continue to be steady. Again, that's largely based off the general economy, which in many cases isn't all that great. But you're offsetting that with the desire for people to get out and be in space as opposed to be in congested areas. Rural residential, we think that's steady to stronger. Low interest rates helping that, combined with that desire to move to more rural communities. But I do want to make this last point. Average to below average farmland and hassle farms are still less desirable. So if you have that kind of farm asset or part of your farm is that, just keep that in mind as you think about pricing and expect maybe some weaker pricing and slower bidding, because that's the feel we get from our auctions today. So here in the fall of 2020, land value bulls can make some really strong arguments as of today. You've got this low amount of debt to assets in agriculture. You've got very low interest rates. You got a low supply of farms for sale. Those all positive if you want to see higher land values. Biofuels continue to remain a factor, but demand is about hanging in that 8 to 10% below a year ago for ethanol. Gas consumption is about 8 to 10% what it was a year ago, so really no surprise. And does that continue? And how long does that continue? And that's really a COVID question, right? But do we ever get back to the travel that we had before? Are we going to do a lot more meetings like this one where I'm sitting in the basement of my office? Or are we going to do meetings face-to-face where I'm coming out to some hotel ballroom and doing a presentation? That's the kind of question going forward on the biofuel side. You got world population growth, which is a positive. Trade deals certainly help, as evidenced by the Chinese phase 1 trade deal. We've seen demand increase quite a bit over the last couple of months. They bought a lot of corn and soybeans, more than we expected on the corn side anyway. Now, are they going to meet phase 1? They're not quite there yet in terms of total dollars, but it's pure proof that when you get a trade deal, it is certainly beneficial to commodity prices. Potential for inflation. This is something you start to hear when you see the federal government push as much money as they have out the door as stimulus packages. Many times that will lead to inflationary time periods. Farmland is very positively correlated to inflation. So if you get higher levels of inflation, that tends to drag farmland values higher as well because people want to hold on to real assets. So if we get into more inflationary times, and the Fed has said they want to see inflation increase, then I think that could be positive for land values as well. And then water resources and competition still remains a question, especially as you look at California and you look at the new laws out there that are starting to really restrict or basically manage water resources out there. That's going to create some properties having much higher values than others that lose those water resources. Not a huge problem here in the Eastern Corn Belt, but something to certainly keep in mind as if you look at investing in other areas. Now, I want to argue the other side of the equation, land value bearish outlook. So what happens to demand and prices if we get another COVID outbreak this winter when flu season hits? Do we work from home again? Do we have another shutdown? That could certainly impact prices for some period of time and could have a long-term bigger effect on demand. You've got weather impacts and trade. Back in June, there wasn't a lot of trade going on and the weather was outstanding and we saw very low commodity prices. That all changed in August and September with the derecho event followed by the drought, followed by a lot of Chinese purchases. So the bears might argue that, well, we're going to get a really good growing season in South America. The yields here in the US are actually going to be better than some people predict. And if you combine that excess production and maybe the trade isn't as good as what we think, could have a negative impact. Not predicting that necessarily, just suggesting that could be an outcome. One of the things that I do think we will find is that US and global production will be enough. And that will probably lead to lower commodity prices. In fact, and I'm not a grain trader by practice or trade, but if I were owning corn or soybeans today, whether I was a producer or whether I was an investor, I would certainly be considering selling some corn and beans at these prices where we're at right now. We've seen a big run up in both corn and soybean prices over the last couple of months. Both are at levels, especially not corn just by itself, but if you combine the CFAP payments on top of the corn price today, both levels for both commodities are at profitable prices. I think you are missing an opportunity if you don't take advantage of to sell a pretty good percentage of the 2020 production at these prices. That's just my personal opinion. I look at it and say we're profitable today, and South America is going to start planting in the next few weeks. We're in the middle of harvest or hitting our stride with harvest and yield reports that end up being positive. You could argue lower commodity prices in the next month or so. I always remember one of those long tried and true trading secrets: short crops peak early, have a long tail. I would be looking at selling now. I would also consider some sales for 2021 if those prices are profitable on your farm operation. got to think out ahead in more than just one harvest. So where that goes in global production, obviously Brazil and Argentina get started planting. They plant a lot of acres due to these higher prices. If they have pretty good yields this year, that would be a negative. World economy tanks. That's going to equal lower demand. We saw that impact during the COVID time period. Go back to that, that certainly would be a negative. Trade agreements are not. So trade agreements are very positive when they lead to actual purchases. But if they don't, or they get torn up, who knows what happens after November 3rd, that kind of thing could have an impact on demand one way or the other. The same on biofuels. We kind of know where we stand on biofuels today, but what about Trump's policy going forward, or Biden's policy, or who knows? So a lot of unknowns on this slide. I'm just throwing out some potentials that could be very bearish depending on outcomes. And then interest rates, they're low right now. But at what point, if we get into some pretty rapid inflation, does the Fed decide to start increasing interest rates, which would have a bearish impact on land values? So those interest rates, obviously, if they increase, they obviously have a big impact on other asset classes' returns, such as liquid treasuries, CDs. They also impact the stock market, and those things might become more appealing to some institutional investors than farmland today. And then my bigger question is, if we look at a trend back down in commodity prices, what about those farmers who have a low amount of working capital and they want to finance the 2021 crop? Where do they find that funding? And will they have to put more debt on the land, increasing that debt to asset ratio to basically stay in operation in 2021? Or will some choose to sell, which drives up the supply of farms for sale, and that would argue for lower land values as well. So a couple of things to think about and watch as the market goes forward. So final slide is our expectations. So this was from September 1 to March of 21. What do you think land values are going to do? That's what I asked each of our staff. You can see 4 of them predicted higher, 9 lower, and 7 the same. Nobody dramatically one way or the other, although one might argue 10% change in land values is pretty significant, but a little bit of a bearish tone to farmland. And I think that's understandable with all the unknowns that exist out there. So I think that's probably pretty predictable, and probably argues that we're going to stay in this sideways channel for the next 6 months. Contrary to that is rural residential lots, obviously higher. Same, 11 people said the same and 9 said higher. So that rural residential marketplace probably remains pretty favorable near term with these low interest rates. And then recreational land, a little bit of a mix, but probably more sideways than anything else. General economy, people getting back to work would help that, but 8% unemployment with less stimulus checks coming out probably keeps that more moderately fine-tuned at this point. So those are our predictions. I know that's about as clear as mud, probably, but I wanted to leave you with the thought that we have gotten an opportunity the last 2 months that we didn't expect. Corn prices and soybean prices and wheat prices went to levels that most people did not predict at the beginning of the year. And so we've got this pricing opportunity combined with the government stimulus payments that probably lead to steady land values for the foreseeable future. As long as interest rates remain low, I think owning farmland remains a great real asset to hold on to, and it's not going to expire or go away on you anytime soon. So with that, Nolan, I'm going to ask if there are any questions out there. So yes, if you have any questions, I would be glad to field any. Yeah, you can use the chat feature down at the bottom of your screen. There should be a button that you can use to chat.
Howard, can you go back to the bar chart on land values, please?
The bar chart on land values.
Shows the historical land values and how flat they've been the last 5 years.
Bear with me here. There are faster ways to do this, but we'll get there. That one?
Yep, that's the one. I think one thing this points out, Howard, since the highs in 2013 and 14, we're still at a fairly high level historically for land values. So if you're looking at selling or have been thinking about selling, we've been steady for 5 years and they look to be steady for a while longer. And we're still at 80 or 90% of all-time highs.
That's a great point, Pat. Pat Karst is our Vice President of Real Estate here at Halderman. And I think I tried to make that point in a slide earlier where I said we're at that 80th percentile. And it would be easy to say, well, gosh, you know, my farm was worth $12,000 an acre back in 2013. It was, and it might be worth 10 today. But 10 is still higher than every price available on farmland prior to 2010 and the centuries before that. So I think sometimes that perspective is helpful. Thank you, Pat. So what impact on farmland values would there be if you saw changes in real estate tax policies? So when we talk about real estate taxes, I'm not talking about income tax. This is the tax that's on the land. You pay it every year, and it's basically what helps pay for the county governments. Some of it goes to roads, schools, all those sorts of things. The impact on that, if let's say a state government decided to push more cost out to the counties, if the counties had to raise their real estate taxes significantly, that could have a real material impact. I showed that cap rate earlier at 3%, with a net somewhere around 275, maybe 2.6%. If you saw real estate taxes jump $10 an acre, $20 an acre, that cap rate drops down, the net cap rate drops down quite a bit. And so then you start to look at how does that farm investment compare to other investments where I can put my money, and can I make a higher yield on other investments? And so usually increased costs, less income on the farmland will lead to lower land values over time. Now, I can tell you, there's some counties in this country where you'll pay over $100 an acre in real estate taxes. And here in Indiana, Ohio, Michigan, you might be looking at $30 an acre. Today, that does skew some people wanting to invest in Corn Belt farmland. They may look at one state more favorably than another because of the real estate taxes that they see in those states. And we have had people talk about avoiding certain states because they have a fear that real estate taxes are going to go up quite a bit. So it does have a material impact. So estate tax today, obviously under the current legislation, allows a landowner or any individual to have a very high level of assets before you get into paying estate taxes. The question is, what happens if that level, that exemption, drops down to previous levels? All of a sudden, that could create taxable estates for many landowners. So it would depend on the level that they would enact at that point in time. But when that happens, then there becomes a desire to hang on to that property. And it will come down to then, how does that impact basis? So right now, it would be more desirable for me to own my farm in my name, pass on because my estate's under the current threshold, and then allow my heirs to inherit it at a stepped up basis before they sold it. And they would have no capital gains tax at that point, and I don't have an estate tax. Well, if all of a sudden that level drops and I do have a taxable estate, then I have to weigh out the differences. If I sell today and pay capital gains, is that less than what I would pay in estate tax, although I would still have that cash in my estate? So what usually that leads to is a lot more gifting and other strategies that landowners consider so they can start to gift away value, gift away shares of an LLC or whatever entity they use to own the land so that they can get their estate tax under that threshold. So it probably doesn't impact land values that much anytime soon, but it does create a lot more work and a lot more considerations by farm families to think about how do they pass their legacy on to the next generation and do it in a tax efficient way.
A recent article on ProPublica.org cited a study by Rodeo Group showing county by county projects of anticipated scenarios of rising temperatures between 2040 and 2060. Can you comment on this and how it might?
Well, first of all, I've not seen the study, so I don't know what it says. Just in general, we've been talking about climate change for a number of years now and a warming trend that the North American continent is under. That obviously changes crop mix. It creates more volatility. And so I think what we will see, so for here in Indiana, maybe historically we've always experienced 35 to 40 inches of rainfall a year. I think one would say that we don't turn into a desert. We don't lose, we actually probably have more rain events, but they tend to be in bigger increments. So you get 3 inches instead of 1, or you get 6 inches instead of 2. And that can be very damaging to soils. It can be very damaging to crops in the field. You might see a lot more days of 90+ degree heat during the summertime. That would lead to maybe a transition to different kinds of crops. It also could lead to more negative yield impacts on crops that need cooler temperatures at night, like corn. So it has a crop mix change impact, would be one impact from that. And then that also then could get into infrastructure. So for example, if we could start growing cotton in southern Indiana, well, that would be fine, but there aren't any cotton gins there. So you would have an infrastructure change if you had to change crops. What it has created, what global climate change has created, is the ability to grow corn and soybeans much further north than what we used to be able to. And so now North Dakota actually is a contributor in terms of corn and soybean production, where 50 years ago they weren't. So positive and negatives, but it basically creates cropping changes and probably more volatile weather conditions, which one would argue we have certainly seen with derecho events and tornadic activity and hurricanes and the like.
That's all I've got. So.
Okay. Well, if we are wrapped up, I really appreciate your attendance this afternoon and your interest in the subject. I think on that last slide, or you've got the ability to email us, feel free to shoot us an email and ask a question, or you can call us on our 800 number, and we'll be glad to help you out with any questions you have about your land. So have a great rest of your day, and thank you for joining us today.